Let's answer some questions from July 31st market outlook. First one here, had a question on GDP discussion. I get your point on inventory effect and imports for the previous quarter, but isn't it true that GDP designed with all these components to enable us to judge about the status of the economy at any time without a need to go back into each of the components? Otherwise, what is the point to have such a measure? Also related to this, would you please explain whether or not you agree with 2 consecutive negative quarter for recession? And another question is, could you please help to understand how to calculate the negative 2.01% change in inventories? So to sort of give you an idea of how quarter over quarter GDP is calculated, it's the number we see is an annualized rate. So we take the change for a quarter and then we annualize it to get the annualized rate. But if there is an outlier in the quarter, you're annualizing an outlier. So let's just have a look at activity. Time period 1, let's say we have 6 components that make up an activity index, and we note 1050. In T2, we note 1070, and we have 6 components here. We can do what's called an attribution analysis. Anybody who's been through level 3 understands how we can take performance of a portfolio. Let's say it earned 10%, the benchmark earned 9%, so we have 1% active return, and we can attribute that to asset class selection, sector selection, even down to security selection. And we can attribute the return to decisions made at each particular level. Well, here we have a difference of 20. If we take 1070 over 1050 minus 1, it's a difference of 1.9%. So let's attribute this 1.9%. Here are the components in period 1. If you add them all up, you get to 1050. And here are the components for T2. Add them up, you get to 1070. And notice what I'm doing in here. These are all aggregate levels. This was at 75, this is now at 100. But this is just a change from the previous level. Because for inventories, we don't count the aggregate level of inventories at any time in any particular quarter. The only thing that can contribute to GDP growth in that quarter is the change in the inventory. If inventories stay flat over the quarter, nothing was added, nothing was subtracted. That inventory that we start the period with is production from previous periods. It cannot be counted in this period. So we'll use one component here that measures just a change. This over here is just the difference between the two, 75 to 100. That increased by 25. This increased by 20. Note here, this decreased by 100. Even though inventories still increased by 150 in the period, it is lower by 100 versus what the previous one was, because all of these sum up to 1070 and all of these add up to 1050, the difference being 20. So if we take the differences, they should add up to 20. There we go. What is the difference between 1050 and 1070? 20. And here we've attributed all the difference to all the components. Now keep in mind, this is still positive, but look at the attribution is negative 100. So let's see if we can get to 1.9%. We take the difference divided by the beginning amount. So we can say that component 1 was responsible for 2.38% of the 1.9%. Component 2, component 3, component 4. Look at what this one here is. You have a negative. Again, inventories grew by 250, then they grew by another 150. Different growth rates on them, but for attribution, we got to get to a difference of 20. This was a result of negative 100, so it contributed negative 9.52% towards the 1.9, and component 6 was 4.76. If you add it all up, you get 1.9%. You get the 20-point difference, and you are able to get to the 1.9, and we're just attributing growth to the different components. So imagine that you had a growth rate that looks like this. Quarter 1, quarter 2, quarter 3, quarter 4. You have a growth rate that looks like this. And you have some underlying trend in that growth rate. But in a particular quarter, you had something happen. Let's say in quarter 1, you had something happen which caused one of the components to spike. which then comes down like this. Well, in this particular quarter, you're going to annualize that growth rate. But in this particular quarter, you're going to annualize this growth rate and notice that it is significantly lower, so you had a drop in growth. Meanwhile, you had some outlier event, like what is going on here. Since the change in inventories, the difference between this, the magnitude can be large because you're not looking at the level anymore, you're just looking at the change. Small fluctuations here can result in large attributions down here. We'll look at the next screen how we can sort of look past that particular attribution, but this is 1.9. Now, if this were for the quarter, we would annualize this. Keep in mind, we are now annualizing an outlier. So same two questions. Now we're going to use the real GDP data that we got for Q2. We're going to look at year over year and quarter over quarter. Year over year, our growth was 1.62% in real GDP. That is Q2. If we look at Q2 of, and we're looking at seasonally adjusted annualized dollar amounts. Real dollar amounts. If you look at Q2 2022 over Q2 2021, real GDP grew by 1.62% over the year. Quarter over quarter, it was negative 0.94. Now what I'm doing down here, this is not attribution analysis down here. We did attribution analysis on the previous screen where you take the difference in a component and you divide it by the top line number. Here, what I'm doing for consumption, I've got all the components here: consumption, investment, exports, imports. That should be an M, not a Y, sorry, M, and government spending. For consumption, I'm breaking down to goods and services. Investment, I'm breaking down into fixed investment and change in inventories. And all I'm doing here for C is I'm looking at C year over year and C quarter over quarter. So I'm looking at the growth rate in the component as opposed to attributing trying to figure out where this 1.62 came from. So don't think these columns add up. So consumption year over year was up 1.839%, Q2 2022 versus 2021. This is in real terms, up almost 2% year over year. Quarter over quarter, it was up 1.03%. And how we get these numbers here for the quarter, if you're trying to get this number for the quarter over here, take the change in whatever the component is. So this is the change in real GDP to get to this 0.94, divided by Q1, add 1 and put it to the power of 4. Because if you take this, if you take Q2, our GDP, the change in Q2 and divided by Q1 GDP, you get a 1 quarter change. You have to annualize that, put it to the power of 4, subtract out 1. So the change was negative 46.2. Q1 real GDP level was 19,727.9. Add 1, put it to the power of 4, subtract 1, you'll get 0.94. That's how you get the 0.94. So you do the same thing here. You take real consumption for Q2 or real consumption for Q1, put it to the power of 4, minus 1. It's the same thing as taking the change over last period, adding 1 and putting it to the power. Here I just have the 1 already included in the numerator. So consumption grew 1.0356%. If we look at the components, year over year, goods, the growth in goods was negative 3.17, quarter over quarter negative 4. Growth in services was a positive 4.6 versus quarter over quarter. And this is because when the pandemic hit, services went almost to zero and all that extra money went into goods. 2 outliers. So those were 2 outliers. Well, then spending on goods dropped, but they're still spending on goods, but it dropped from where it was in the pandemic. So year over year, it's going to show negative. But if you looked at the change in goods consumption for Q2 2022 over, let's say, Q2 2019, you could then imply a 3-year growth rate. You got positive growth. It's just you're removing the outlier to get at the trend. So whenever you have an outlier in a data series, sometimes it's worth looking past that outlier and looking to previous periods where the outlier didn't exist and imputing what the growth rate is without the trend or without that outlier. In investment spending, here's where you get the outlier. In consumption, not much of an outlier except when you look at the components, but investment spending year over year is up 8.68%, but quarter over quarter is down 13.492. So for the year, we're up almost 9% on investment spending, even though the quarter was down 13.492. Fixed investment year over year is up 1.24, but down 3.84 over the quarter. Look at these numbers. These are not normal numbers. Inventory was up 73% year over year from last year. You don't inventory intangible stuff. You don't inventory services. These are all goods, up 73%, but quarter over quarter, negative 96%. These are not normal numbers. So you want to try to look past these things. Here, this negative 96 quarter over quarter, you're compounding an outlier. So how do we get the negative 2.01? Well, the change in inventory quarter over quarter was negative 106.9. So now we're going to do an attribution analysis where you take the change quarter over quarter divided by what the level was last quarter, add 1 and compound it for 4 quarters, or you could just multiply it by 4. You'll get close enough. Subtract 1, you get to 2.18 versus 2.01. How come the difference? Well, because it's not really 106.9. It might be 106.854, and this is not 0.9 here, but because of the rounding off, you're not going to quite get, we're off by 17 basis points here. You're not going to quite get the same number. If we had it right to the decimal place with the pennies, it would be exact, but that's how you get the drop. But keep in mind, you are compounding an outlier. These are not normal numbers. Exports year over year up 6.8%. Second quarter over first quarter up almost 18%. Imports were up 10, almost 11% year over year. Quarter over quarter up only 3%. Again, there is some outlier function happening here, which is a function of transportation and shipping. And then government spending is down 1.6% year over year. Well, you can always say that's a good thing, right? And quarter over quarter down 1.9%. So if we want to look past the anomaly of Q1, look at year over year, 1.62. And if you want to look over these anomalies, what you want to do is compare Q2 of 2022 with Q2 of 2019. That's a 3-year rate. Figure out what that change is and take the third root. Not 1 over 3, sorry. Take the third root or put it to the power of 1 over 3, a geometric return. And you'll get a 3-year implied growth rate that will remove those middle things. So if you have the trend that looks like this, and somewhere in here you had this kind of stuff going on, well, you're going to pick up all these things. But if we look at this number and we look at this number, we're looking at this trend in here and eliminating all of this stuff over here. Look at this. This is not normal. Those are not normal numbers. But in doing quarter over quarter, you have to compound this particular outlier. That's why looking at the negative numbers for Q1 and Q2, if you look past them, if you look at year over year, or if you look at pre-pandemic versus 2022, you'll find that it doesn't meet the definition of a recession. A recession is a broad-based decline in activity, not an anomaly in one or two sectors. You have consumption spending that is increasing. You have consumer credit that is increasing. You have a job market that is extremely tight with wage gains at 7-8%. Real retail sales are positive. If we are in a recession, it is the most unobvious recession anyone's ever seen. That if you didn't listen to the news at all, you wouldn't even know you were in a recession. If you go to the mall on a Saturday at 11, you would say, "What recession? There's no parking spots. And it's only 11. What recession are you talking about?" So no, they're using the word technical recession. Technically, yes, but this recession is going to come with a big asterisk. We were compounding an outlier in both Q1, the rapid increase in GDP showed, sorry, not the rapid increase in GDP, the change in the imports brought GDP down. Whereas in Q2, we didn't have that problem, but all of a sudden, all those imports resulted in an increase in inventories. Well, you had to deal with that, right? So I hope that kind of helps there. Okay, first question. Can you work us through how you construct the par rate tables on the first slide? Which resource do you use? I use treasury.gov. And if you look in the description box, it is the first link. There'll be a menu across the top. You'll see one that says data. If you click on data, you'll get some listings of what you can get. Click on the first one. Those are your par rates. The second last one are your real rates. So how do I construct those tables? I read them right off the website. You simply wouldn't have the information available to be able to calculate a constant maturity rate, the amount of bonds that you would need to get that done, and the complexity and the time required to get that done is hours and hours and hours. They already do it for you. So that's where I get it from. I had one question on the 1 month Treasury yield being less than the Treasury T-bill. On the T-bill yield being less than the lower end of the Fed funds rate, why can't banks and whoever access the reverse repo facility short sell 1 month Treasuries, invest the proceeds in the reverse repo facility? Well, you're not actually investing the proceeds in the reverse repo. The reverse repo is you're accepting a security. You're buying a security from the Fed and agreeing to sell it back to the Fed the next day, and the Fed will pay you 2.25%. So you're not actually getting funds. You're getting a security from the Fed, and you're lending the Fed money. So your money is going to the Fed. Also, if you started short selling, that would affect your risk-weighted assets, and for a bank, you don't want to do that. Besides, the reverse repo is 2.25%. Why give it back on the 1 month rate? Why short a 1 month T-bill? You're going to have to pay the interest expense on the 1 month T-bill. That would be your cost of funding, even though you're getting 2.25. If you could, you're getting 2.25 guaranteed. Why even change that? You'd be just giving back the 1 month rate. Not only that, you have to borrow the security to get that done. So not only are you going to pay the interest rate on the security that you shorted, you got to pay the borrowing rate on the security that you borrowed. So there just really is no way to get that done. And the reverse repo is you have a Fed over here and you have a bank over here. The bank will lend the Fed money. The Fed will give the bank a government security as collateral. The Fed agrees to buy the government-backed security back the next day, and the implied interest rate comes to 2.25%. And that's how the reverse repo works. So the bank is actually giving the Fed money, and the Fed is giving the bank a security, not giving it funds. I know this is not the topic of the video, but I would like to know how you think about the swap curve in relation to the constant maturity yield curve, and what the spread between the two can tell us about the market. When it was LIBOR, it used to tell us something, because LIBOR was an unsecured rate between AA rated banks, the rate at which they would lend each other money. So it told us something about the risk in the banking system, and we could look at the difference between the swap curve and the constant maturity treasury curve to imply the level of risk that exists in the banking system up and above what the government curve would dictate. And sometimes it was above, sometimes it was below. Well, just to be clear before I describe what's going on with with that curve. Now, the swap curve is a par curve. It is a series of rates that would create a par bond if that were the coupon on a coupon paying bond. Same with the constant maturity yield curve. It is a par curve. So they're both par curves. This par curve is a curve of government securities that are backed by the full faith and credit of the government. The swap curve now is a secured rate. It is based on a secured rate because it is backed by a government security. So it is a secured rate backed by government securities, which is backed by the government. So in both cases, you have the government that is backstopping the security behind both of these curves. The difference here is you are exposed directly to the government, whereas here you have collateral that is worth a little bit more than the loan that you gave. So it's a little bit more secure than just this curve over here. So it would not be surprising to see swap curves below the constant maturity yield curves because of their secured nature. So what does that tell us? Not much anymore. I don't know that there's a lot of information in that, because if you trace it all back, what's sitting behind the interbank swap curve? Securities backed by the government. What's sitting behind the constant maturity yield curve? Securities backed by the government. So I don't know that you can read anything into that other than, well, this is secured by these securities, which is at times over collateralizing the loan. I shouldn't say at times. It over collateralizes the loan. So being that it over collateralizes, you could get a few basis points lower on each rate. Okay, let's compare U.S. Treasuries over here with two types of swap rates. Here are 1 month term swap rates, and here are annual swap rates. These are the rates that would be quoted if you're looking at entering into monthly or swap with monthly resets. These are for annual resets. The 1 year here, this is based on the run treasuries, and these rates are based on secured funding, over collateralized, slightly over collateralized secured funding. 3.109, 3.145, and 3.199, both of them are higher than the UST rate. But when you get into the 2 year, 3.097, this is lower at 3.038, and this is lower at 3.082. Go to the 10 year, 2.784, and the 10 year here is 2.545, which is lower, and the 10 year here is 2.575, which is lower. The collateral here is just the full faith and credit of the government. The collateral here is a security backed by the full faith and credit of the government, but it's over collateralized. So the rate is based on a loan that is, you could argue, a little bit more secure than these loans, even though they have the same issuer. Okay, first question: what is the true definition of full employment when it comes to the Fed's mandate? I know NAIRU is an odd measure, but if we look at employment through the NAIRU lens, then they've totally and completely screwed things up on that side of things too. NAIRU is usually cited as the level of full employment because it is the level of unemployment, I shouldn't say employment, it is the level of unemployment that would lead to no change in the price level. So it is called the non-accelerating inflation rate of unemployment. So NAIRU is a rate, RU is the rate of unemployment. It is the non-accelerating inflation rate of unemployment. So you could have wage growth of 2%, but that 2% per year does not, at a certain level of unemployment, does not lead to accelerating inflation. So what is that number? It's hard to pin down to an exact number. It really depends on where we are in the economy. So you could be at 5% with extreme wage inflation, so NAIRU would be something higher than 5%, or you could be at 3.6% with huge wage inflation, which is where we are now, so it's somewhat higher. The frictional level of unemployment in the US is somewhere around 4.5%. In Canada, it's somewhere around 5.5% to 6%. Frictional means that there is a sort of a natural rate of unemployment with people quitting jobs or leaving jobs and then going to other jobs over a period of time that just happens. In the US, it's about 4.5%. That's about a rough guess. We're at 3.6%. So yeah, you could use, if you got to 4.5%, maybe you would see wage growth dissipate a little bit. We had JOLTS data this week. The job openings have dropped. That's not surprising because of the number of job freezes that are going on. A lot of job postings were probably pulled. You still have 10.6 million. You still have over 4 million quits. 4.3 million quits. That's the thing you have to pay attention to. That many people quitting means they feel perfectly comfortable quitting to get another job. Most of those quits are because they're jumping from one job to another at a higher rate. Several weeks ago, we looked at the Atlanta Fed wage growth tracker, and we saw that the highest wage growth, the highest gains in income growth were going to those who switched jobs. And as long as you have that many openings and a quits rate that high, you're not going to budge that 3.6% unemployment for quite some time. That unemployment rate could actually drop or not even drop. I shouldn't say drop, could go from 3.6 to 3.5 or stay at 3.6 even with job losses if the participation rate drops just as quickly, which is why we have to keep our eye on the participation rate. Remember now, you have more people retiring per year than you have entering the labor force per year, because though that generation that's leaving is much, much bigger than the generation coming in. And you cannot manufacture 18-year-olds. You can manufacture babies, and in 18 years you'll have a whole bunch of 18-year-olds, but you cannot do anything to manufacture an 18-year-old or a 25-year-old. You can use immigration, but let's go on to the next question to see if that's doable. Powell stated that there is no reason to worry about a recession at the moment because of how strong the labor market is. I agree with that statement. Do you believe that the type of jobs being added matters? Not really, not the type of jobs, because when we're looking at aggregate demand, we're not so much looking at how many people have a job, we're looking at aggregate incomes. So if another person gets a job and starts making money that they didn't have, that is money that will be spent. So it will add to aggregate demand, even though it's not buying a Ferrari. So we don't have to worry about price inflation in more expensive goods, but it's still adding to aggregate demand. That person will still buy services and will still buy things, even if they can't buy the good stuff. In the last report, it stated that professional business services increased at 74,000, with leisure and hospitality services a close second at 67,000. And if we look at where the major gains in income are happening, it is happening here more than it is happening here. That being said, do you believe there's a chance that a large portion of the jobs being added are low-paying jobs? Well, yeah. The economy is a pyramid. The highest-paying jobs are at the top. There are very few people with the highest-paying jobs. All economies have a lot of people that are making wages. And the further down you go, the larger the number of people that you'll find. Hence the expression, it is not crowded at the top, you know. That being said, do you believe there's a chance a large portion of the jobs being added are low-paying jobs that many are able to afford to have? So let's, economics gets pushed around a lot because it oversimplifies things. It doesn't reflect reality. We don't build models to reflect reality. We build models to help us understand reality a little bit better. We know it doesn't reflect reality, but we want the least amount of variables that we can have. And the test of a good model is not does it look like reality? The test of the model is it useful? So when we're talking about aggregate demand, there are two big drivers of aggregate demand: aggregate incomes and the marginal propensity to consume. And when we talk about aggregate incomes here, we specifically mean disposable personal income. So if you make $1,000 and I tax 50% of it away and you only have $500, you really only have that $500 to spend. So we talk about the disposable personal income when we talk about aggregate incomes. Even if somebody takes a job at the lowest wage right now and nobody else loses their job, that person is going to add to the aggregate disposable personal income available in the economy. Multiply that by the marginal propensity to consume, and you get a contribution to aggregate demand. It doesn't equal aggregate demand because there's more to incomes or more to aggregate demand than just increases in income. Governments are insensitive to the level of income that they make when they decide to spend. It seems that their spending decisions are completely unhinged from the income that they make. Wouldn't that be nice? To be able to just make your spending decisions without any regard whatsoever to your income? Oh, that's handled in a different room of the house. I'm the spending room. We just make up our own mind what we want to spend. We don't even talk to the income room. We just spend. Wouldn't that be nice? Anyways, in the economy, for the central bank, I should say, we have what's called the Phillips curve trade-off. You have unemployment and you have inflation, and you can get very low levels of inflation if you're willing to accept high levels of unemployment, or you can have very low levels of unemployment if you're willing to accept higher inflation. So there is the trade-off. And the Fed has what's called a Phillips curve mandate because they want to promote full employment with price stability. That is their trade-off. They're willing to trade those two things off. They want to be somewhere in this zone in here if they can. So, back to economics now. Is this useful? We calculate disposable personal income. When am I ever going to use that? I hear marginal propensity to consume. Oh, this is so boring. When are we ever going to use that? Well, let's use it now. How do we lower aggregate demand? We have two variables. 1, 2. Let's look at the marginal propensity to consume. Raise the level of interest rates in the economy. That is monetary policy. Why would that lower the marginal propensity to consume? Because it measures the opportunity cost of consumption, induce more savings. So let's say that I can get a 7% yield on a government bond. And let's say my wages are growing at 5%. 7% is greater than 5%. Why work more hours when I can have my money work for me? You would induce more savings and you would lower the marginal propensity to consume. So you could have aggregate demand drop without any drop in aggregate incomes if you can get people just to stop spending money. How do you get them to stop spending money? You make investment attractive. You make them say, I could buy this thing for $1,000, but that bond is paying 7%. Why don't I just buy that? The other thing that you have to keep in mind is there is a relationship between R and the inflation rate. So if I want to buy this thing for $1,000 and you're telling me that I can make $70 over the course of the year if I just invest in that, if I expect the price of this to be $1,100 in a year, that's not going to be enough. Sorry, that's not going to be enough. But if I expect it to be $1,050 in a year, well, okay. That's not too bad. Now we're ignoring taxes on this, so you'd have to look at the return you get on an after-tax basis. But that is basically saying that the interest rate, to affect marginal propensity to consume, the interest rate that I get, the nominal interest rate, not the real, the nominal interest rate must be higher than my wage growth, number one, and must be higher than the rate of inflation at the same time. Well, we have wage growth. The Atlanta Fed shows the aggregate wage growth of 6.7%. You have top line inflation at 9.1%. We have an interest rate, even if you take the 10-year, less than 3%. I took the 2-year here at 3.09%. 3.09 versus 6.7% wage growth versus 9.1 CPI. Are we going to affect the marginal propensity to consume? Big answer here, no. No, you're not. Okay, so we can't do a lot of work on marginal propensity to consume. The rate is simply too low. Can we affect disposable personal incomes? This is where the fiscal comes in, the monetary. That's the end of the job for the monetary right there. The other thing that higher rates do is it lowers investment spending. And if it lowers investment spending, it could lower employment. So that's why I put B over here for business. Business has a role to play because the monetary and the monetary creates an environment in which businesses make these types of decisions over here. What can the fiscal do to do something so that the unemployment rate doesn't have to budge, but we lower disposable personal income? Number one, raise taxes. This is what Keynes said. When you're faced with this type of situation and you need to reduce aggregate demand, one of the best tools that fiscal policy has is to raise taxes. You increase spending in a recession, you're giving people money in a recession. It's only fair to take it away in an expansion. Raise taxes, it will reduce the disposable personal income without reducing the jobs that are available in the economy. If you reduce disposable personal income, even if you can't affect the marginal propensity to consume, you can lower aggregate demand. Not going to happen. Not going to happen. Biden is not about to raise taxes, and if he does, he's going to raise it on that group of people who earn more than they spend. In other words, they have a marginal propensity to save that exceeds their consumption. So if you raise taxes on them, all you're doing is hitting their savings. You're not going to affect aggregate demand one bit. So taxes just aren't going to be something here. And you can raise taxes in a number of ways. You can raise a sales tax. You can raise the personal tax. You can raise corporate taxes, won't do much, but the personal taxes on paychecks, you can raise those 2, 3, 4%. Anything to reduce this number. Reduce government spending. And whenever a government spends, it's somebody else's income. So you can reduce government spending by reducing any overtime in the system, reducing any hours worked. Say, okay, everyone's going to cut back 2% on all the hours worked, so that everybody keeps their job and everybody works two hours less. Well, that will reduce disposable personal income. Also, you could just reduce employment, right? And if you raise R high enough, you create the conditions under which business will begin to reduce overtime, begin to reduce the hours worked, and even take the step of reducing employment. All of that will lower DPI. So that is where we are. If we want to get inflation down, you have to get aggregate demand down. You get aggregate demand down in one of two ways: reducing the marginal propensity to consume or reducing disposable personal income. Those are the only two ways. Now let's say that you don't get rid of anybody, but wage growth drops to 2%. Well, disposable personal income would increase by 2%. You haven't done anything. You actually have to destroy aggregate demand. You have to get aggregate demand down, which means this or this. Lower the marginal propensity to consume or lower disposable personal incomes. Not lower the growth rate in it, but actually lower it. You're not going to raise taxes. That's just not going to happen. So it all has to be carried with this. And really, I've said this before, if you ever want change in an economy, if you want things to happen, don't look to your elected officials. You got to look to business. Businesses are the true leaders of all societies, or all free societies and all free economies. Businesses are your true leaders. Politicians just mess things up along the way. That's it.